There are a ton of crucial factors influencing the markets right now, from earnings season still being in full swing to people holding their breaths waiting for data on inflation, jobs reports, and supply shortages, to a certain health crisis which must not be named, possibly making a return, God forbid. And so with all these things in mind, here are my top 8 underpriced stock picks for the month of at least August that I am personally buying.
It's showtime!
And the first of these stocks is the e-commerce play Etsy, which has recently come back down to previous support levels off of missed guidance from its earnings report. Specifically, they sort of reiterated what Amazon said a few days ago about e-commerce as a whole slowing down more than expected because of the reopening still going pretty strong, at least up until some of these earnings calls happened. However, in my opinion, this milder guidance actually allows for even more potential to surprise to the upside for the next earnings call, especially if the Delta variant, God forbid, starts to intensify. And what I mean by this is if the reopening slows down and people start to stay at home more again, this could actually subvert the expectations from the earnings call that the reopening is actually accelerating, right?
Right.
And so in summary, what I'm saying is that stay-at-home plays and e-commerce plays like Etsy and Amazon could actually see not as much of a slowdown in e-commerce growth as they'd actually predicted. And even if that doesn't turn out to be the case, I still believe that Etsy is a great stock to buy and hold for the long run because they did actually beat on most of the earnings metrics, being their top and bottom lines. And also the stock price is also trading at a discount after the missed earnings guidance. And I also really like Etsy's business model because they're able to carve out their own niche even outside of Amazon's and eBay's influence by focusing on things like DIY, handmade, and custom-made items.
I want that.
And on top of that, I also really like their growth strategies and prospects from expanding to other territories by, for example, acquiring other platforms from different countries, which can be done quite feasibly with their healthy balance sheet and also great marketing strategy that actually enables them to target new audiences and bring back old customers. Plus, let's not forget that there still is yet a huge total addressable market for e-commerce over the next few years still yet to be plucked. Speaking of which, you can't talk about e-commerce without mentioning the biggest e-commerce player there ever was, which is indeed Amazon, and it is the next stock that I am buying. And the reason that I believe the stock is a good deal right now is similar to that of Etsy, where the company actually guided for slower than expected growth, which then resulted in the stock actually selling off. And on top of that, another reason that I think likely contributed to this sell-off is the fact that Amazon actually reported its first revenue miss in 3 years, which I don't actually think is that big of a deal due to the reopening likely dampening e-commerce performance, and also that Amazon still has a lot of growth ahead of them.
Of course!
And I also think that I have good reason to believe in this growth because, first of all, Amazon actually hired 50% of their current workforce over the past year alone. And secondly, Amazon is still heavily investing in expanding warehouse capacity, with many of their buildings actually set to open in the second half of the year. And third, I believe that Amazon can yet expand upon their profit margins to better match that of other big tech by focusing more on the growth of their more digitally based services like Amazon Web Services, which by the way actually provides database storage options, computing power, and things like content delivery and networking among other things to help organizations scale up. And this part of their business is actually growing rapidly as well, so we can definitely see some of that margin growth from this segment alone, on top of the fact that Amazon also has other businesses like their streaming services and gaming and so on and so forth. In fact, Amazon's AWS was actually its main profit generator for the year, accounting for a whopping 54% of its total operating income for the year, with a 32% share of the global cloud market, even ahead of both Microsoft and Google. Also, Amazon's so-called other unit, which is comprised primarily of their advertising business, also saw a huge 87% year-over-year second quarter growth compared to the previous year-over-year percentage growth of 41%, which is actually a great sign of the acceleration of this part of their business as well.
Would you like to know why Amazon is so successful? Because the customer is all that matters.
Oh, and suddenly it's morning here, and that's because I think the future of this next company, the social media platform Pinterest, is very bright indeed. Now, as for what Pinterest does as a company and a platform, I did cover this in a lot more depth in my previous video, so I'll be sure to link that down below if you're interested in checking that out. But essentially, why I really like Pinterest's growth prospects is that not only are they able to carve out their own niche with a very visually based and product-based platform, but because of this, they're also able to monetize and have a very large profit margin. And that aside, another reason that I believe Pinterest is a great buy right now is again for a similar reason to Etsy and Amazon, in that people are going out more during the reopening, and thus they're on their phones less and on the internet less, leading to fewer monthly active users according to Pinterest's latest earnings call. And this, coupled with some uncertain guidance, is likely what led to Pinterest's stock price suddenly selling off to a previous support level, which is a level that I'm very comfortable in buying. And I do think that Pinterest presents a ton of long-term upside because besides disappointing on their monthly active users during their most recent earnings call, they actually beat on both top and bottom lines. And not only that, they actually grew on their average revenue per user, or abbreviated ARPU, which means that the company is actually operating more efficiently. Plus, Pinterest is still heavily investing in improving content, pinner experience, advertiser success, and shopping features, all of which I think bodes really well for the company moving forward. And last but not least, even Cathie Wood's own ARK Invest has been buying up Pinterest lately, stating in a recent newsletter that a lot of its woes could be attributed to a post-pepperoni or perhaps not so post-pepperoni environment, as we'll see in the coming months, and also suggesting that it could become a prime beneficiary of the shift towards social commerce. And now onto my next couple of stocks, and these are ones that I've already been buying over the past few months continuously, and in terms of their prices, they haven't actually dropped that much compared to any of the other stocks on this list. However, I still fully believe that they are underpriced relative to their future growth, especially not only in their own industries, but also having the potential to expand into other industries as well. And the first of these that I've been buying pretty heavily recently is none other than the electric car maker, solar energy and sustainable energy company, and self-driving car company Tesla. And for a little bit more context in terms of what I want to invest in, Tesla is my primary avenue for getting exposure to electric cars, self-driving vehicles and robo-taxis, and sustainable and solar energy, all of which I think will play a huge part in our lives in the future. And Tesla in particular seems to still be growing at a ridiculous pace, beating out earnings most recently at a whopping 46% and revenue at a decent margin as well. And so perhaps one of the biggest takeaways from Tesla's most recent earnings is that they were actually able to grow their profit margins quite significantly and thus their money efficiency. Plus, demand for their vehicles has been stronger than ever, with their Texas plant slated to start production towards the end of the year, with their Berlin plant following suit soon after. If anything though, Elon Musk did mention that production is somewhat constrained by supply shortages, which is also why I believe that the stock price hasn't reacted that much to the earnings, in that it actually did go up a little bit, but not very much compared to how well they actually did in terms of their earnings beat. And so I actually think that if some of these more short-term supply shortage issues clear up, it'll also pave the way for higher stock prices as well. And onto my fifth good deal stock that I'm buying right now, we have the chip maker AMD, for which its earnings actually saw a very similar narrative to Tesla's, in that it actually beat greatly in EPS, beat significantly on revenue as well, and also grew its gross margins by 4% year over year. And I believe that one of the primary reasons behind these consistently great earnings and beats is that AMD has successfully been able to continually grow its market share even against the likes of Intel, not only in terms of CPUs but also in other chips, especially since it actually closely collaborates with the leading semiconductor producer, Taiwan Semiconductor. Not to mention, AMD does seem to have even greater prospects ahead of them from their impending acquisition of chipmaker Xilinx, which will help them expand upon their chip-making repertoire even further, as well as research and development capabilities and even profit margins, as Xilinx does have really good profit margins, and to AMD's continual commitment and quote-unquote strategic expansion into other industries and niche products such as data centers. And on to my stock number 6 that I'm currently buying, we have another one that I've actually talked about before, and I'll link that video down below if you're interested. But anyhow, the stock in question is the telemedicine company Teladoc. And if we compare its stock price right now to when I last discussed it, it's actually about the same, likely due to the fact that its most recent earnings also slightly missed expectations. However, if we actually dig deeper into its earnings, we'll find that a lot of the losses can actually be attributed to their recent merger with another telehealth company, Livongo, which means if we actually factor out that merger, we'll see that Teladoc actually turned profitable, and very profitable at that compared to having a loss just a year ago. And another important factor to consider is that because of the huge growth numbers caused by the pepperoni in 2020, this actually became more difficult to compare back to in 2021 because you can't really expect to meet the same types of growth, right? Although Teladoc did still actually grow its user base in 2021, albeit it did miss on expectations a bit, but more importantly and notably, it actually was able to retain even more users in 2021. And I also think that Teladoc's acquisition of Livongo bodes well for this trend because it really rounds out Teladoc's services to chronic care, making it a great destination and a versatile one comprising of holistic care in terms of both physical and mental health. And also with the new variant or variants of this pepperoni spreading around, which I really don't want to happen, but if it does, this could actually give Teladoc even more margin to surprise with the upside for its next earnings. And speaking of which, my very next stock could also do well if more people start to work from home and or if this actually becomes a new normal. And the stock in question is the freelancing platform Upwork. And it's yet another stock on this list that has done really well during the pepperoni in terms of its business and stock price, but has yet also missed expectations because of the reopening. And whether or not we get yet another large pepperoni wave, I still like Upwork for giving me exposure into the online freelancing and workspace, which I do believe is poised for a lot of growth over the long run. Not to mention, Upwork has still been investing heavily into growth and new features and has been able to maintain and even grow a large profit margin at a whopping currently 73%. And real quick, for sort of a bonus honorable mention stock that's not technically on this list but that I like to mention anyway, we have another freelancing platform, Fiverr, which has actually also seen a sharp dip as of late for similar reasons to Upwork. Personally though, even though I've been both a seller and a client on Fiverr, I still prefer investing in Upwork because I believe that it actually hosts much more professional and scalable work. And I also believe that Upwork is a safer investment than Fiverr, and I can actually explain this using an analogy, which is that Upwork is more similar to Amazon, which is a lot more structured and actually screens sellers, whereas Fiverr is more of a hodgepodge similar to eBay, where anybody can go on there to sell stuff, but there's also sketchy stuff going on. And last but not least, onto my final stock, and this is one I've talked about multiple times in my past videos, so I won't spend too much time on this as my thesis hasn't really changed, and it's the video gaming company Activision Blizzard. And what I like about Activision Blizzard is that it has a very strong moat and decent brand loyalty with super popular franchises like Call of Duty, Candy Crush, and a lot of the Blizzard Entertainment franchises like Warcraft, Diablo, and Overwatch. And like many of the other stocks on this list, its stock price has also been beaten down lately, but it's actually due to a lawsuit that's been going on with the state of California regarding sexual misconduct in the workplace. And while there is currently quite a bit of negativity and controversy surrounding the company, I also believe that when they do make these changes for the better, this will definitely do well for the company over the long run. And even on top of this, restructuring and streamlining really seems to be the theme for Activision Blizzard over the past couple of years. And so I really believe that Activision Blizzard will start hitting their stride again very soon with their foray into mobile gaming, as well as huge blockbuster titles in the next few months. And also, if we just quickly examine Activision Blizzard's most recent earnings, we'll also see that despite not having any major blockbuster releases, it still was able to log quite significant growth at 48.1% earnings growth year over year, as well as 18.8% revenue growth over the past year. And those are my top 8, in my opinion, undervalued stocks that I'm picking up right now and likely moving forward, which by the way is not financial advice. And by the way, you can pick up your free stocks using the Robinhood link and Webull links below. And with that, thank you so much for watching. Let me know what you're buying this month, and I will see you in the next video. Peace.